you, Patrina. Thank you, Clement. Thank you, Marcos, for your good work. Good morning and welcome to the members of the House Financial Services FinTech Task Force and to our distinguished panelists. So since the pandemic has severely narrowed the scope of our work in the closing weeks of session, and because of the urgency of competing priorities like the HEROES Act, and because of our committee's wider economic response, it has limited our opportunity to take up other important legislative initiatives. We thought it would be helpful to restart that process in a way by having an informal discussion about the near-term possibilities for blockchain-related legislation in a way that allows us to reconcile the enormous potential that blockchain offers our society, but also acknowledging and addressing the concerns around fraud and investor protection and the possible facilitation of unlawful activities like tax avoidance, drug trafficking, and terrorist financing, among others. This morning, I am absolutely delighted to introduce a stellar group of experts and deep thinkers on this issue, who I believe can help us introduce and optimize the use of blockchain technology in a way that meets the highest expectations of all of the stakeholders in our society. So let me begin by introducing our panelists. The panelists for our event are Neha Narula, Director of the MIT Media Lab Digital Currency Initiative. The Digital Currency Initiative is dedicated to researching blockchain and digital currency, serving as a convener for stakeholders in blockchain technology and promoting diversity in education within the blockchain and digital currency spheres. Wright is Associate Clinical Professor of Law and the founder and director of the Tech Startup Clinic at Cardozo Law School. Professor Wright is also co-author of Blockchain and the Law, a very good book that I highly recommend, especially for lawmakers. I'm going to talk a little bit about that later. I have a quote from it. And he is also an expert in internet and emerging technology issues. Mr. Wright has previously testified before the House Committee on Science, Space, and Technology on this very same topic. Denelle Dixon is the CEO and Executive Director of the Stellar Development Foundation. The foundation supports technical and business communities with Stellar blockchain ecosystems, which was launched in 2015. And Stellar is an open source network for currencies and payments. I just want to say, parenthetically, Mr. Wright, I did read your book a couple of years ago when it first came out. I know you wrote that along with your co-author, DeFilippi, Blockchain and the Law. I highly recommend it. I actually read it twice. In my e-version, it is heavily highlighted. I think it's an excellent book. It gets into the more profound issues, I think, around blockchain and what it means for our society. I think it's very, very helpful for lawmakers to think about those different dimensions of this rather than just a single issue or a single technology. But I do want to read one quote, which might guide us as lawmakers. This is a quote. It says, "Despite showing great promise, blockchain-based networks run the risk of creating discrete risks that could destabilize central banking," and indeed, the Fed has come out and voiced those concerns. "It could also destabilize financial markets and the administration of commercial agreements. And blockchain may support new forms of unlawful activity," which you might think will be a concern to lawmakers. "These risks are particularly acute because the technology is deployed to rework fundamental systems and institutions that define our modern society," the very definition of a revolutionary technology. So as we begin, I want to say that our goal here in the task force is, and in these very sober discussion, is hopefully to raise the level of understanding of blockchain technology by our members and the public to match the level of excitement around blockchain technology. So with that, I will ask Neha Narula, Director of the MIT Media Lab Digital Currency Initiative, to offer your remarks. Thank you.
Thank you very much, Congressman Lynch. And hello, and good morning to everyone. I want to thank the members of the committee for inviting me here today to participate in this member briefing. So as Congressman Lynch said, my name is Neha Narula, and for the past 4 years, I have been the director of the Digital Currency Initiative at the Massachusetts Institute of Technology. I am no stranger to MIT, having received my PhD in electrical engineering and computer science from MIT in 2015. The Digital Currency Initiative, or DCI, has a mission to make it as easy to move value as it is to move information by engaging in neutral and rigorous research and while serving the public good. We are computer scientists and open source software developers who have been working on architectures for digital money since 2015. And might I just add, I'm really happy to have the opportunity to engage further with lawmakers. We don't often get that as computer scientists. I'm also honored to currently be working on a multi-year research initiative with the Federal Reserve Bank of Boston to determine if we can design, build, and test a robust digital currency platform that can meet the needs of a national retail payment system. So I just wanted to set the stage a bit. I think our financial system is just not currently working for everyone. The poor pay the highest fees. We've seen examples where the wealthy have been able to flout AML and CFT rules in cooperation with large banks, and it's taken months for people in the US to receive their stimulus checks. And at the same time, we're seeing this massive digitization as more and more of our economic activity moves online, but we don't necessarily see the capacity to provide consumers with exciting new low-cost services. So we have an opportunity today to rethink money rails and value rails at a fundamental level and to build a foundation for a more inclusive, innovative economy. We can meet consumers where they are, onboard more of them, and provide better integration with digital services. But not only that, we can begin to research how to take advantage of this new technology, to consider new and more efficient models for enacting our public policy goals. But we must be responsible and cognizant of the risks of the technology and the incentives of the participants involved. It's not clear it's best to follow the path of internet platforms, where what started as a very open, competitive landscape, the web, evolved to monolithic companies which emerged with control over all aspects of our digital lives, including civic discourse. These companies have emerged as de facto gatekeepers for what news we see and what programs we're allowed to run on our devices. And it's clear to me that as we engage in this next era for digital money, we need to be thoughtful and focus on open, accessible platforms which promote competition and choice. Though we might be tempted to rely entirely on the exciting developments in the private sector for this innovation, the ethos of move fast and break things is not going to work for global payment systems. Central banks responsible for safeguarding financial stability are rightly entering the fray to more deeply understand the risks and promises of this technology. In addition to this important research and development, we need to deeply interrogate new technologies and examine their underlying incentive structures. Some people have proposed that blockchain technology is best suited to build upon and to create economic innovation. So you will hear about systems that utilize blockchain technology and blockchain-like data structures. I want to stress that whenever you hear the word blockchain, you should remember to ask which blockchain. That is very important, as they all have different designs, features, security properties, and incentive structures. Saying something uses blockchain is kind of like saying I would travel between Cambridge and Washington, D.C. using transportation. That could be Amtrak, a 737, or a bicycle. There are many different ways to build digital currency and to build this innovation, many of which can provide interfaces without requiring a blockchain. We're currently in the research phase, and we need to make sure we're including neutral, unbiased, rigorous technology researchers in the conversation. And of course, we must consider the underlying tension between privacy and enabling our public policy goals to prevent criminal activity and fraud. This, to me, is the most interesting research question we face today. I think that the technology can actually help us quite a bit here. But we have to be willing to think beyond our existing structures, which I would argue are not necessarily working well enough anyway. So we really have this opportunity here to rethink these structures from the ground up, using this technology where applicable. I thank you very much for your time, and I'm greatly looking forward to this conversation.
So I would like to introduce, previously introduced Aaron Wright for your opening remarks. Welcome.
Thank you very much. Thanks, Representative Lynch and members of the Committee of Financial Services. I really appreciate the opportunity to brief you on this important topic. And Representative Lynch, thank you for the kind words. As noted before, my name is Aaron Wright, and I'm a clinical professor at Cardozo Law School, where I direct Cardozo's blockchain project. My research focuses exclusively on blockchain technology. Over the past 6 years, I've written extensively on the topic, including, as noted before, co-authoring a book, Blockchain and the Law, The Rule of Code, which was published by Harvard University Press. The way I like to think about this is the modern day alchemists who birthed Bitcoin into existence brought to life a new technology that has the potential to profoundly impact the delivery of financial services. Many have analogized blockchain to the internet, and while that analogy is often not a perfect fit, it serves as a useful way to understand the technology. The internet enabled us to send information across the globe nearly instantaneously. And if you think back to an era before the internet, it was difficult to send things like a letter to another person. You'd have to write it on paper, drop it in a mailbox, and have that letter routed through a number of intermediaries before it was delivered to its intended recipient days, if not weeks later. The internet changed that with email and obviously other forms of technology. Messages could be sent nearly instantaneously anywhere around the globe, regardless of the jurisdiction of the intended recipient. And the internet fundamentally and dramatically reduced the cost of sending messages. And this simple change has had a lasting impact on how parts of society are structured. Industries have altered business models. Media consumption has shifted. E-commerce is replacing brick and mortar establishments. And we're now grappling with new challenges as the internet matures. Blockchains fundamentally, though, are more than just money. They may do the same thing for finance, and they may even, in the most optimistic light, underpin the next generation of the internet, what folks are calling the decentralized web or Web3. And open, permissionless blockchains fundamentally do move assets almost like email. They reduce the cost of transmitting value and potentially thin the need for intermediaries, creating opportunities and obviously regulatory challenges. Today, blockchain technology is still growing. In a sense, we're still in the eval phase. We're still doing research, as just was noted. The assets relying on this technology are often natively digital, cryptocurrencies like Ether and Bitcoin, and tokens of various different stripes. It may look like a toy, but in the long run, we could see other forms of tangible value increasingly relying on blockchain technology, including tokenized forms of intellectual property, securities, lending interests, and title to real property. As more assets move onto a blockchain, and as the technology is able to handle more complex financial transactions, we may see financial business model shift. New ways to engage in financial services that benefit consumers, along with novel regulatory challenges. Over the past 5 years, blockchain technology has rapidly developed as technologists have increasingly explored a technology related to a blockchain known as a smart contract. Smart contracts, as a term, is a bit of a misnomer. They're not legal agreements, although they can be. They're computer programs that enable the creation of more complex and automated financial products. And they can also automate all or parts of contractual relationships. These computer programs or scripts are stored and executed via blockchain, which help developers program how assets can be pooled and transferred. For example, they can be used to define rules related to digital assets. They can create trust or escrow-like relationship to pool funds. They can transfer digital assets to one or more persons. They can render assets non-transferable. They can record information to a blockchain, enabling digital voting schemes that could be useful for corporate governance purposes. And they could be triggered based on outside information, what technologists call an oracle. These three building blocks, blockchain, smart contracts, and oracles, have enabled the creation of a number of blockchain-based financial services that are just coming to the fore. Lending services, insurance services, options and derivatives platforms, stablecoins, and tokenized securities. Some of these services are highly innovative. By way of illustration, smart contract-based systems are enabling exchanges that do not rely on a centralized order book or even centralized exchanges. Lending protocols are emerging that don't judge potential borrowers based on a person's race, neighborhood, or educational background, They simply look at a person's assets that they have on hand. Organizations called DAOs, or decentralized autonomous organizations, are popping up that are highly democratic in terms of how they're operated and transparent in a way that could improve the way organizations operate. We're also seeing a whole bunch of proofs of concept that point to other areas where blockchain technology may present some improvements. Blockchain-based and online arbitration systems where an arbitrator has the ability to settle a judgment over the internet with less of a need for enforcement in a traditional court. We're even seeing proofs of concept around real-time payroll systems where workers get paid in near real time, and where conceivably the government could collect taxes in real time too. Despite these opportunities, smart contract-based financial systems create regulatory challenges. Today, as I'm sure many of you are fully aware, many financial legal regimes impose rules and regulations on intermediaries who are in the best position to manage financial risk or protect consumers. With blockchain technology, the need for these intermediaries may be thinned or reduced. Smart contracts are hard to modify and change once deployed, and they're being deployed by technologists around the world. These smart contract-based systems are alegal in nature, often neutral to regulation, and thus they may not have certain compliance obligations baked in at their core. As an example, smart contract-based exchanges today, one illustration of this is smart contract-based exchanges. Today, exchanges not only serve as marketplaces to buy and sell securities or other assets, they often also mutualize risk through clearinghouses. These clearinghouses prevent cascading risk by stepping in if a member of the exchange defaults. Blockchain technology has not yet developed or imported some of these tools found in advanced marketplaces to manage these types of risks. Many of the smart contract-based systems also do not have embedded within them compliance regimes that ensure compliance with the Bank Secrecy Act or state money transmitter laws. Blockchains also make it easy to create new digital assets, some of which have appreciated rapidly in value, creating complex classification questions relating to whether these assets should be treated as securities, commodities, or something else. Like many technologies, blockchains present a tremendous amount of promise and risk. Over the long run, they may fulfill their vision of creating a more participatory, open, and decentralized financial system. As the technology develops, however, like the internet, it raises complex challenges, especially if financial services are being provided by autonomous, smart contract-based systems and not centrally run companies. Thank you very much, and I look forward to any questions.
Thank you, Aaron. Next, we'll go to Denelle Dixon. You're right for your.
Good morning, Chairman Lynch. Good morning, Chairwoman Waters, Ranking Member Emmer, and members of the committee. Thank you for having me at this briefing today. I'm honored to speak with you about the functions of blockchain technology in financial services and to answer any of your questions. My name is Denelle Dixon, and I'm the CEO and the Executive Director of the Stellar Development Foundation. I've been in this role and working in blockchain for the last 16 months. Prior to that, I was the Chief Operating Officer of Mozilla, the maker of the Firefox browser, where I spent my time focusing on the intersection of business, technology, and public policy. In both of these roles, I've advocated for and highlighted the importance of privacy, net neutrality, encryption, the need for openness and interoperability in technology, and fostering competition and creativity on the web. Today, in my role at SDF, these policy issues remain an important focus, as there's a need for openness and interoperability in blockchain so that we can foster competition in our space as we did in the early days of the web. The Stellar Development Foundation is a non-stock, non-profit corporation. We have no shareholders, we have no owners, we have no profit motive. We are not a charity. We pay state and federal taxes, but our structure allows us to be beholden only to our mission, which is creating equitable access to the global financial system. We look to accomplish this mission by making money more fluid, markets more open, and people more empowered through the use of the Stellar Network. Our work at SDF is broad, and yet we are focused on this technology stack. We shepherd the code base for the Stellar Network. We support the growth of the ecosystem and the use cases built on top of Stellar, in addition to supporting public policy and education around Stellar and blockchain generally. So, what is Stellar? Stellar is an open, permissionless, decentralized ledger or blockchain network that is optimized for payments. There is no single entity, including SDF, that controls the code base of the network or its growth. You don't need permission to use the technology. It's just like the underpinnings of the internet. It's open and ready for your use. The many third parties building, innovating, and growing the network are a testament to our open source background and are the source of financial innovation and inclusion. Using Stellar makes it possible to create, send, and trade digital assets backed by nearly any form of value, and to do so in a compliant manner. The network interoperates with the traditional financial system to leverage the benefits of blockchain technology to enhance, but not supplant, existing infrastructure. The Stellar network has been operating for over 5 years, and today the network processes over 2.5 million daily transactions with over 4.5 million accounts. So as members of this task force have likely heard, there are countless applications for blockchain technology within the financial services sector. I want to focus my comments today on just one, and that's payments, particularly cross-border payments. The World Bank estimates global remittances totaled $714 billion in 2019. For 7 countries last year, remittance inflows accounted for more than 20% of the GDP. And according to the UN, 800 million people, that's about 1 in 9 globally, are supported by funds sent home by migrant workers. Unfortunately, remittances remain expensive and slow. According to 2019 data from the World Bank, the global average cost of sending just $200 across a national border is around 7%. So many people and economies are dependent on high-cost remittances that the UN created a sustainable development goal to reduce the per-transaction cost of remittances to less than 3% by 2030. So this is where blockchain can help. Sending any transaction across a border on Stellar, whether the value is $2, $20, $200, or $2,000, is fast. It takes less than 3 to 5 seconds on average, and it costs fractions of a cent. To give the task force a live, real-world example of how Stellar creates this equitable access to the global financial system, I'd like to focus on Nigeria. It's the 6th largest remittance market at over $24 billion annually. So Cowrie, it's a regulated fintech company in Lagos, Nigeria, provides cross-border payment services for the Nigerian market, and that's powered by Stellar. By tokenizing the Naira and integrating with the Nigerian Interbank Payment Network, Cowrie developed payment rails that enable low-cost and instant payments into and out of Nigerian bank accounts. So their product, which is called NGNT, a digital asset that is backed one-to-one fiat Naira, is available on Stellar today for cross-border payments and digital asset exchange. Now, Cowrie plays an important role providing access to Stellar in Nigeria. But then there's another anchor, we call them anchors, these financial institutions, that's on Stellar, this one in Europe. It's a fintech company called Tempo that issues digital assets backed one-to-one by the euro. So with Tempo and Cowrie as endpoints, Stellar enables payments between the EU and Nigeria that are completed in 3 to 5 seconds, nearly instantaneous, nearly free to the developer. And there are built-in compliance tools on Stellar that allow entities building on the network like Cowrie and Tempo to complete the Know Your Customer, the KYC, and anti-money laundering, AML steps required by their respective regions. So this generalized asset issuance toolkit that's built into Stellar includes the ability for the issuer to take in the required information before issuance or redemption of the digital asset. So it empowers them to meet their compliance obligation. This functionality is built in at the protocol level, as tokenization is a fundamental part of the network. So the supporting code is reliable, it's vetted, and it's fast. And when the digital assets work together, as they do in the Cowrie Tempo example, converting fiat in Nigeria into a digital asset, sending those assets to Europe, converting that digital asset back into fiat in Europe, and ultimately depositing that fiat into bank accounts of businesses in Europe, a connected global financial infrastructure is created. That's how interoperability comes to life. And that's what makes Stellar and blockchain a powerful technology. Remittances are a core use case for Stellar, and expanding the network of anchors, these financial institutions, building on Stellar is one of the ways we seek to create this equitable access to the global financial system. In addition to accessibility, Stellar's technology could go a long way toward achieving the UN Sustainable Development Goal. So as you consider these type of policy objectives, I want to make myself and my team available as resources to the task force, And I'd love to know how the task force members are thinking about remittances, payments, and digital assets. Thank you so much for having me here today.
Thank you, Denelle. And I can assure you that, we've been looking at that issue of remittances. And on that note, I would also like to introduce our chairwoman, Maxine Waters, who I think it's fair for me to say, and she can correct me if I'm wrong, one of the most attractive parts of this whole idea of blockchain and different platforms, Ethereum and others, is that it holds the possibility of banking the unbanked. And as Neha and others have acknowledged in their remarks. So with that, I'd like to introduce our chairwoman, Maxine Waters, the gentlelady from California, for her remarks.
Thank you very much, Chairman Lynch. I'd like to thank you for holding this briefing and for your leadership of the committee's FinTech Task Force. Blockchain technology has great potential for innovation in financial services, and it is extremely important that this committee continues to explore the various potential benefits and risks in its use. While cryptocurrency is one of the most well-known use cases for blockchain technology, I look forward to hearing even more from this panel about other and more inclusive ways to utilize blockchain technology. I just came in on the hearing a little bit late, but I was able to hear how it is being used in Nigeria. That's very impressive. I was also able to understand how we could reduce the cost of remittances, which I think is so very important. And don't forget, in my district, that is 47% Latinx, we have remittances that are going out every day to many of the Latin countries. And so I'm very, very interested in this cryptocurrency, period, blockchain in particular. And again, I thank you, Chairman Lynch, for all of the effort that you're putting into it. You're our leader, and we're looking for you to bring this to us and help us move at the right time in the right way. Thank you so very much. I yield back.
Thank you, Madam Chair. I do appreciate it. Thank you for your keen attention to this issue for all the right reasons. So I'll begin by yielding myself a few minutes just for some initial questions, and then we'll go in order. Patrina, I think, will control the run of show in terms of who's next. But Neha, I did want to, you mentioned that you're working, that IT yourself are working with the Boston Federal Reserve, and that they are, I was happy to hear one of our previous hearings several months ago, they mentioned how their goal was developing a platform for payments within the Fed. However, I think when I asked how soon we might expect that, they told me 2025 or something like that. So it was a very long horizon. And so I'm just curious, is that still our understanding? Because, Congress is slow to begin with. We are slower than the technology is changing in our world. Let's put it that way. So we struggle to keep pace, to put it kindly. What is the current prognosis in terms of where we are with the Fed in developing sort of an institutional platform that might facilitate real-time payments? Where are we on that?
Thank you, Chairman Lynch, for the question. I want to stress that I cannot speak for the Federal Reserve Bank of Boston. I do not represent them, nor the Federal Reserve System. However, as I said, I'm very honored to be doing this work with the Federal Reserve Bank of Boston. We are phrasing this currently as research. We don't believe that the technology, we have knowledge about enough knowledge about the technology yet to give any sort of firm design or firm opinion on what the technology design for a central bank digital currency or digital dollar should look like. It's also not up to us to decide whether or not we should be issuing one. That is the job of Congress. I will say that a central bank digital currency or digital dollar, should one be issued, would be critical infrastructure. It would be extraordinarily important, and it would be subject to a lot of attack by hackers and even potentially other nation states. So it's really something that we want to make sure that we get right. And that is why security and resilience are our number one priority as we engage in this research. How do we build such a system securely? And, I mentioned responsibility earlier in my remarks, and I also mentioned that we have to think carefully about incentives, and we have to think about the role of the private sector and how that will complement the role of the public sector. Unfortunately, a lot of entities in the private sector have chosen to issue tokens and do token sales. And what ends up happening is that there is a foundation or there is a company that owns a vast majority of these tokens and thus has a financial interest in their technology and in pushing their technology as a platform. So even though it's open source, there might be some interesting financial incentives at play. And I think that's part of why the Federal Reserve Bank of Boston decided to work with us at a university. And it's going to be very interesting to see how this technology develops.
Yeah, thank you very much. I appreciate that. What prompted that question was actually your comments as well as Denelle's about how Stellar is operating sort of an open source, nonpartisan, no commercial interest, that type of platform. So the subcommittee actually had the opportunity to travel to Indonesia and Singapore last year, and they have, first of all, they have a very disparate population with people living on thousands of different islands, many of them unbanked. And they also have the advantage of they don't have a legacy brick and mortar banking system that resists some of this change. So they've come up with some innovative sandbox sort of pilots that are exploring a lot of the things that we're discussing. That's why the time frame issue was, I know we're in a competition in a way. We want to get this right. You're absolutely correct in that. We want to make sure we get this thing right. And Eric Rosengren's a real resource for this committee and personally for me and for my office. So we work with the Boston Fed. So I would like to take you up on your offer of collaborating with the task force. All three of our panelists today. That would be wonderful to have your expertise. It's a full-time job keeping up with the changes in technology and trying to reconcile that the potential that we have here for progress, but including banking the unbanked, but also realizing that we have a lot at stake because we have a financial system that has a lot of integrity. We're the model for the world, and we seem to be getting a lot of stuff right now. But this is a time of enormous change. This is a moment of great consequence in terms of where we go next with this technology. So we would be blessed if we had your expertise, that of MIT. We had actually planned a fintech boot camp at MIT, but because of the pandemic, that got pulled down. But hopefully, if we get a vaccine next year, we'll renew that effort, and hopefully we'll be able to collaborate in person. So I'm going to yield. I've taken more time than I intended to. I do know that a couple of our members have expressed the need to go to other hearings. So I'll leave that up to Patrina to call the order of show here and introduce the next speaker. Thank you.
Thank you, Mr. Lynch. Mr. Davidson, I will now go to you if you have any questions.
Yeah, thank you so much. And I'm just euphoric that we're having this meeting. Wish we would have known a little further in advance, but I'm grateful. And to the committee and to Mr. Lynch, thanks for putting it together. To the panel, I'm impressed with your backgrounds and the quality of work. And frankly, it gives us a good chance to illustrate, one, the payment systems and, not inherently currency as a piece of this. But a lot of times this space is completely conflated with Bitcoin. The use cases are as infinite as the use cases for the internet. And so with the credentials here on cybersecurity, for example, could get at some of that. And frankly, the decentralized platform that Stellar's working to build can illustrate some things. And this is why this is really not a partisan topic. The Token Taxonomy Act, which we put together in this collaborative way from a meeting back in September of 18 in the Library of Congress, has people as diverse as Scott Perry and myself as conservatives, to Tulsi Gabbard and Eric Solwell on the other side. This is where Women in Color and Blockchain have hosted numerous events and invited me to speak. Darren Soto, and now a member of the Energy and Commerce Committee, and I introduced this bill. And I think one of the key things that we need to do is to provide some legislative clarity so that the innovation continues to happen in the United States. So, Denelle, I would be curious if you could address some of the barriers to raising capital in the United States, where if you saw Unicorn just had a $6.1 million judgment because they did an ICO, launched a coin, and they did it in a way that, frankly, even under our bill, wouldn't qualify. They couldn't skirt securities law if our bill had passed. They did it in a speculative way to raise money to create something that wasn't yet in existence. It would inherently look a lot like an investment contract, and that's what the SEC decided. So I think there's a fear that if we provide any kind of legislative certainty, it's going to open Pandora's box and all this bad things happening. The reality is the fraud that's taken place in some cases could be made better by legislative certainty. So could you speak to that?
Yeah. Thank you so much. I think that this is an issue with respect to clarity on the securities classification. I think it only helps with respect to this market, and it only helps with respect to the new players that are coming to it. We didn't do that. That's not how Stellar came to life. That's not, we didn't have an ICO. We don't have any of those things. Again, the profit motive is very different with us, but there are really exciting players that are coming onto the market, and there's a lot of fear with respect to classification issues. And so we are losing some innovation because of that fear. And I think that creating some stability around these issues and clarifying the issues would make it so that there are bright lines and there are rules that players can know that they need to follow as they enter this environment. So I think in general, this is just a really nice step to take.
Yeah, thanks for that. And kudos, you definitely have a clearly different organization structure. And I think it bypassed all that. So it's really exciting, and it highlights the ability to do things with blockchain and payments and the speed. I love that you highlighted how much more efficient this is than our current architecture. And, as is recognized, we have large incumbents with huge stakes in seeing the status quo preserved. But a key part of this is, technology does disrupt things. And a key part of it is, are we going to use this financial system and whether it's securities law or, Federal Reserve regulation or our whole banking system as a system of control, or are we going to use it as a system of empowerment? Are we going to use money as a tool or as a system for trade and commerce? Or are we going to use it as a system of control? And so as China moves forward, they're clearly using it as a system of control. And the United States, in our free and open society, we really have the possibility to do this in a way that has less central control, but actually more secure. So, Neha, I was just curious if you could talk about true distributed ledger technology and maybe how Bitcoin, as an example, goes about security versus something with a traditional relational database or something like SQL database would go about security, and how much more secure is that versus, a fixed point security system?
Thank you for the question, Mr. Davidson. I want to stress that I've worked in databases and distributed systems for over a decade now. So this is an area that I'm pretty familiar with. And when I first learned how Bitcoin worked, and I want to stress, I'm going to use Bitcoin as an example, but it's, we're talking about the technology more broadly than Bitcoin. So, but when I first learned how it worked, it was really a revolution in the design of secure distributed systems. It was a very different way of designing these systems securely. So the way that blockchain-based systems are designed, the ones that have a decentralized network, is that they are built so that almost anyone can join the network. Normally, when securing a system, we put a fence around it. We try to keep the bad guys out. These systems actually expect that the bad guys might get in. They welcome it from the beginning, but they are designed in such a way that using cryptography, using digital signatures and hash functions and very importantly designed consensus algorithms, the bad guys never can get a foothold and they can't really affect the users as much. So it's really a very novel way of designing a distributed system. Now, I don't want to paint this technology like magic. There are certainly assumptions, there are certainly things that could go wrong, but I will say it is very much a novel way to design these systems. I think that we can learn a lot by what has and has not worked in what I call the Wild West of the cryptocurrency world. That has been a giant laboratory where we've been able to see a lot of these designs play out. And so we have the opportunity now to pick and choose the best of that to create secure, open systems.
Thanks so much. I could talk to you the whole panel for probably an unlimited amount of time. My time is not unlimited, and thanks for the generosity. It's gone over a bit, so thanks a lot. Really appreciate the committee again and the expertise of our witnesses and guests. Thanks very much.
Thank you, Mr. Davidson. I'll now go to Ms. Waters for her questions.
Thank you very much. I had not anticipated, raising many questions, but basically listening. But since I've been listening, I think I have been motivated to find out a little bit more. So for Ms. Narula, some experts claim blockchain technology used for distributed ledgers is revolutionary. Others claim its application is only muted and most successes will be incremental over a number of years. Given that, what's your assessment of the current legal and regulatory framework with respect to the use of blockchain in securities trading? What should Congress be focused on in terms of improving that framework to ensure appropriate safeguards are in place?
Thank you for the question, Chairwoman Waters. I'm a computer scientist. I'm not a lawyer, but so please take my comments in that context. I think that it's important to consider what should be done in the short term versus the long term. And again, I'll stress this technology still has quite a while to play out. I think in the short term, probably my fellow panelists could give more insight into the issues that the private sector and businesses are struggling with respect to clarity. I will say that it is very important to enforce our existing securities laws and that they are still applicable and that there are reasons why they exist. And this technology does not circumvent the need for those laws. So I'm a firm believer that we should enforce our existing securities laws. In terms of the long term, I think that there really is an opportunity to rethink quite a swath of our financial regulation, which is a daunting task and must be broken down appropriately. In particular, quite a bit of our financial regulation is based on the idea that there is an intermediary. There is an institution which sits between two consumers and a consumer and a business who mediates those actions, whether it is by holding funds in escrow or by facilitating an exchange or some other sort of financial transaction. This technology enables us to build these types of transactions without an intermediary. Given that that's the case, we will end up having to rethink how some of our financial regulations operate in order to work in this new context. I think there's really an opportunity here to step back and take a look at our public policy goals, what we're trying to achieve, and considering the new technology, which honestly isn't just blockchain technology. There's been digitization in the financial industry happening for the last few decades. Previously, it would have been impossible to do for a bank to store millions of transactions on paper, but now it's quite fast on a computer system. So there really is an opportunity here to rethink some of that. Thank you.
Thank you.
Thank you, Ms. Waters. Next, I'll go to Mr. Foster for his questions.
Katrina, we might have to go to the next person, and we'll try to figure out bills and go back to Mr. Foster. Okay? Thank you.
Yes, Mr. Lynch, if you had any additional questions, we could go back with you.
Okay. Actually, I know that is Mr. Perlmutter. He was supposed to have another appointment. Did he have to leave?
Yes, sir.
He did. Okay. All right.
Yeah, Steve, am I audible at this point?
There you are. All right. I yield.
Okay.
I yield.
Yeah, they just have so many of these volume controls in series. They keep adding one per month and on all these things. All right, first off, so you know who you're talking to, I'm probably the only member of Congress who's designed and programmed a Python blockchain client. Okay, but after having thought about this for a long time, it's my belief that for high value transactions, whether you're talking digital contracts or currency transactions, we will inevitably need a trusted third party, ultimately relying on a trusted court system, which I believe will be a competitive advantage to the US and the free world. For example, trusted third parties will absolutely be needed, first off, to reverse mistaken or fraudulent transactions. And an example of this is someone drags you into an alley, puts a gun at your head, tells you to get out your cell phone and transfer a bunch of digital currency to an anonymous account. Do you have recourse to some trusted court system to authenticate yourself, show that this was a fraudulent transaction, authenticate, and have them unmask that participant in a legally traceable manner and let the justice system work? I think that will be an absolute requirement. It will also be needed to detect and prevent fraudulent trading. And a simple example of that is wash trades. This is where you set a fake price for Bitcoin by a transaction to yourself under two anonymous names. That seems as though you're going to have the trusted third-party access to the de-anonymized transactions under some trusted legal thing. And as I mentioned, that trusted court system has to be able to unmask participants when fraud or criminal activity is demonstrated, not just suspected, but demonstrated. And finally, that means that it has to be able to provision secure digital identities in a legally traceable manner, which seems to me an essential government function. I've actually introduced legislation to actually start the U.S. in that the real ID ecosystem that is being set up in the U.S. is probably the first mechanism where you have biometrically deduped people. Anyway, so my first question, first off, is there a clean technical implementation of a trusted third party, that has all of those abilities that I just went to? Has someone just bit that off and say, here's what the court system would look like, here's how you control the digital key that the court has access, has control over, that allows it to reverse transactions? And are there reference implementations that have that? Or is this just too much of an anathema to all of the Bitcoin crowd that they just, they haven't really conceived of this?
So thank you for the question. I don't know that there is anyone out there that figured this out and that the particular issue that you have identified there. I will say that if we look at I'll raise two issues. First of all, with respect to assets in specific, there are compliance controls that an issuer of an asset, for example, on Stellar, could put in play with respect to the digital asset once it's sent. So if you could put controls around not only which type of entities that it could get sent to, if they've already been KYC'd and had their AML put in play, when they have to go through that process, for example, And then that asset holder could reverse transaction should they keep that as part of their compliance space. That doesn't get to the point about a trusted third party, but it does offer the ability for asset issuers, for example, in a CBDC situation, to be able to do that. And then the other thing I want to point out is that the immutability of the blockchain itself and the fact that the financial institutions that actually hold the assets on the edges, they are regulated. They have to do KYC. And if you just take that Twitter example from recent, where there was the fraud on Twitter, where they were able to trace within some small number of days who held the assets and who committed that fraud. It was 17 days. That was a pretty remarkable thing, and only allowed because of the immutable nature of blockchain generally.
That's right. But a competently executed currency can be made functionally anonymous. And I believe there are widely regarded as anonymous currencies out there. And I just don't see how you're going to be able to allow those for high value transactions because of the problems that I outlined. I think all four of those things that I outlined are an absolute requirement for high value transactions, and you have to face that. And secondly, well, as I mentioned, I think all of this depends on the starting point has to be a secure digital identity, which allows someone to digitally authenticate as a unique, specific human being that has been digitally deduped, biometrically deduped, so you can't get identities in 5 different states and then start playing games with that. And so that prevents identity fraud. It seems like that's an essential government function. And like I say, there's legislation I recently introduced to start getting the US to catch up the world. And finally, if you accept the need for trusted third parties, what are the advantages of blockchain versus simply account-based central bank digital currencies, which will have higher performance, lower cost, more simplicity, and the same number of trusted third parties, namely the court system and the central bank? Does anyone want to grab that? What are the advantages at that point? Once you accept, you need a court system you trust and a central bank regulator you trust. Then what are the advantages of blockchain?
So Representative Foster, I think that's a great question. And I think that is one direction in which blockchain technology, or as we described previously, just the digitization of financial services could evolve. You could see something like a central bank digital currency being deployed, assuming that it achieves the policy objectives that it is intending to achieve. And then other computing systems mimicking or replicating things like smart contracts, where the ability to move those assets in a more efficient way, structure the flow of those assets. And you can also see that evolving in an ecosystem that isn't maintained by a public, open, permissionless blockchain. I think that, and I'm sure Neha can speak about this, I think there may be some security trade-offs that need to be evaluated there. But I do agree with you that decentralized identity or some digital-based identity system will at some point be an essential piece of this emerging technology stack. There are many technologists today that are exploring implementations of this. They're hoping to do it in a way that's not maintained by a central party like a government, but is instead maintained by an open source protocol or system or service that can maintain this information, validate it, and plug that into other parts of the blockchain-based ecosystem. But the basic fact that parties need to know who they're transacting with and should be able to rely on that in some capacity, I do believe is an essential part of what we will see. And I also do agree that governments historically have served in that role, administering identification systems in different capacities. So it does make sense for the government to explore whether or not they can play a role here, whether that's the federal government or a state government, I think is obviously a complex question that would need to get examined.
Yeah, well, it's also internationally. Anyway, so I'm over time here. If we get a second round of questions, I'd be happy to do that.
I also would be happy to address the congressman's question whenever it's appropriate about why a blockchain technology when there's a trusted third party.
Why don't you have a crack at it right now, Nate?
Okay.
Yeah, thank you.
Yes, Congressman Foster, that is a question that we think about quite often at MIT, especially with the central bank, where there obviously is a trusted third party. What is the benefit of blockchain technology in that environment? I want to stress blockchain technology does not eliminate the need for intermediaries. However, sometimes the technology of the protocol can take over some of the functions that the intermediary was providing. I do not believe that it can take over all of the functions that some intermediaries are providing. So what we'll see is that things will evolve with a slightly different structure. Now, with central bank digital currency specifically, I think it's helpful to think of blockchain technology as an umbrella under which there are many different smaller pieces of technology. One of them is the consensus that might make it a decentralized protocol. I don't think that's necessarily appropriate for central bank technology. However, what might be appropriate is some of the cryptography that is used in blockchain technology. For example, digital signatures to help authorize a user's payment, and things that could help us do better validation and verification. So we're actively exploring the spectrum of different technologies and to see how they'll affect CBDC. One specific area we have identified where I think we will require something different is to enable offline payments. We believe a central bank digital currency should support offline payments in times of crises, and cryptography can be very helpful to secure those.
Are there actually implementations of offline payments that avoid the double spending problem?
Usually they do not completely avoid the double spending problem, but they can help box it in, limit the effect of the double spending problem.
Yeah, usually by just limiting the size of the transaction.
Yes, and requiring some verification. Yes.
Yeah, so you just say, I'm going to allow fraud for payments under $50, and that's fine. Or, you know, someone drags you into an alley out of internet connection, puts a gun to your head, does the transaction. If it's less than $50, it'll go ahead and you're out of luck. And that's maybe an acceptable regime to live in for offline transactions. But you can't irrevocably transfer the deed to your house in an offline manner. So it's a matter of small transactions. You could have small transactions. You could have 99.9% of all transactions go through digitally, but for that 0.1% where there's trouble, you have to have recourse to a court system, and then you have to have, you know, the digital key that court will possess that allows it to reverse transactions is something that's going to be as heavily guarded as the encryption key that allows Apple to sign a new release of the iPhone software. You know, there's going to be, you know, that whole business with a protected digital key, and it seems like that's an acceptable future, but we just have to start designing for it. And so all of your technical people, I urge you to actually take that on and come up with a reference implementation of that, because I think that's eventually where we'll have to go.
Thank you, Mr. Foster. We'll now go into our second round of questions. So we'll start back with Mr. Lynch.
Thank you very much. I know some of the members have hearings at 10, so anybody has to log out. We understand that. So Aaron, in your book, you really, blockchain and the law, you did a great job in terms of causing people to think about what you refer to as lex cryptographica, how the progression of blockchain and the decentralized nature of it, the cross-border international nature of it, could actually undermine what we do in Congress in terms of representative democracy and being somewhat of a trusted third party, if you will, not only for the regulatory function within our financial services industry, but law in general. And you talk about how that could be, these very fundamental institutions within our society could be disrupted, or I forget the word you used, but I would say circumvented or eliminated, perhaps, if this development went unchecked. I wonder if you could talk about that in terms of democracy, not necessarily just financial services, but democracy writ large?
Thank you very much, Representative Lynch. That's a great question. And this is thinking about it theoretically and in the long run. But one way to think about open, permissionless, blockchain-based systems is that they create a set of rules that participants on these networks or participants with the underlying smart contracts are agreeing to. So it structures the behavior between different parties. So Bitcoin is a great example here. There aren't bureaucratic rules that are sitting behind Bitcoin. All the laws that support today a central bank in the US or in another jurisdiction, they don't exist with Bitcoin. Instead, it's primarily, if not exclusively, governed by these code-based rules. Now, humans and people are involved in that process, and there's certain decisions that they get to make. But fundamentally, at its core, these code-based rules are governing the day as it comes to Bitcoin. So that means that transactions are not reversible because that's what the protocol dictates. That means that it's going to be very difficult to potentially implement certain changes because you have a whole bunch of different people that are operating and running on this network. We're seeing the same kind of implementation of these code-based rules emerge not just for base digital currencies or cryptocurrencies, however we want to classify them, but also in other financial services products where people are interacting with code-based systems to perform a financial service. That could be an exchange that isn't run by a centralized company like we have in the US or in other parts of the globe, but instead it's an exchange that's run just by software. And people decide whether or not they want to interact with that software or not. And due to the nature of a blockchain, because once the software is deployed, it's very difficult to take that software down, preclude people from interacting with that software. If people decide that they want to use this software, it's going to be hard to preclude them from doing that, except by taking steps that I think many policymakers would consider to be highly draconian in nature. Going after individual consumers, potentially banning technology off the bat, which is not something, at least here in the US, that we've tended to do. And that creates certain challenges and complications if many people choose to use these services over the long run. So right now, it's tens, if not hundreds of thousands of people that are using these things. But in the future, if that becomes millions, tens of millions, hundreds of millions, or billions, like we've seen with other technology platforms, then that can create a challenge to the existing financial system. And that, I think, is a concern to the extent that these systems are not designed to have compliance baked in at their core. So issues related to fraudulent transactions, terrorist financing, et cetera, are not accounted for in many of these systems. And that's just going to require pushing, as I think folks mentioned in the past, pushing some of that compliance to the endpoints, which may be a sufficient solution, but it's not going to ensure complete compliance, particularly if there's individual consumers that are involved. And I think with Bitcoin and other cryptocurrencies like Ether, we saw this applied to just payment systems or things that try to mimic or replicate payment systems. And I know that that's not a perfect analogy, but what we're seeing over the past couple years is that the sophistication of the financial products that are being provided are just increasing dramatically. It's no longer payments, it's also exchanges, it's also lending platforms, it's also insurance platforms, it's derivatives and options related contracts that people are interacting with. And that's just a reimagination of it. And there's lots of benefits to it, but there's also significant challenges.
In the end, it would create for me, it's a rule of law problem. Would you agree?
Yeah, so it could, right? In many ways, these systems could be complementary, right? Maybe we learn new mechanics that actually improve how consumers receive financial services. Maybe we see increased speed, lower fees, less reliance on centralized parties that are making decisions. Let's say, as a good example here would be lending decisions, which many people have raised a number of issues related to, in the past, how are loans administered? If it's entirely algorithmic, maybe that's superior. But at the same time, if this technology continues to get adopted by everyday consumers, not just here in the US, but across the globe, the mass of people that are opting into these systems can grow large enough that it can be competitive to some of the more highly regulated systems. And that's the challenge, right? How do we capture all the benefit that this technology may provide while at the same time preserving the rule of law and also certain policies that we think are beneficial either for the US's interest or because we want to protect consumers. And that is a difficult problem, particularly, as Neha mentioned, and I agree with, it's not clear what intermediaries are going to be involved in this process at this point in time. I also agree that there will be some intermediaries. Maybe it's trusted third parties that emerge in different capacities, but it's not clear yet who those are. So it's not clear who should be the one bearing the regulatory responsibility.
Thank you very much. I yield back. Thank you.
Thank you, Mr. Lynch. We'll go to Mr. Davidson for his questions.
Yeah, thank you. Just a great discussion, and hopefully we'll continue this kind of dialogue and maybe do it in the context of some of the bills that we have in committee in an official hearing. So thanks again to the committee and for Mr. Lynch for getting this down the road, and of course, for Mr. Emmer on the Republican side of the FinTech Task Force. So, Aaron, you highlighted about, the structure, and then earlier, really, in the dialogue, just the whole architecture, from a cyber perspective, is kind of a different way, cybersecurity perspective is kind of a different way to think about it. And so in some ways, the entire architecture, it runs kind of parallel to the current financial system, where there is a third party. And I think that's one of the hard things for my colleagues to kind of think about. And so you see this idea of the trusted third party, and often the recourse is a trusted government, a government entity that sits in the middle. And, unfortunately, our government hasn't perfectly been this neutral third party. And we're still dealing with sins of our past for having not done that well, legacy, even in say, our housing programs or things like that, where our government really facilitated, unjust systems. And so you have a true distributed ledger that runs differently. Aaron, you alluded to it. And in America, we have been reluctant to go after the people that use this. But I'll just highlight as an example, the founder, Ross Ulbricht, is serving a double life sentence plus 40 years for creating something the government considered too private, right? And he was ahead of his time in terms of the idea of creating a private network. It was an ideological problem and frankly facilitated completely illicit activities. And so, you paint otherwise good technology with these bad actors. And I think that's the fear when we don't provide legislative certainty, we don't provide legislative clarity. Innovators can step outside the bounds of accepted norms and frankly do bad things. And they're held up as examples of the technology. We don't do that with the U.S. dollar. I mean, clearly the most fraudulently used black market thing is the U.S. dollar. And that's the benefit of being the world's reserve currency. But I guess when you think about just this last question, just cryptographically, you think about the distributed ledger, it really is an open ledger. So while you can do it with some level of privacy, it's not true secrecy. So you can follow the moves. And we've seen how, for example, the Mt. Gox theft was ultimately solved by following all the moves, something that couldn't easily be done with cash. So I'm not positive who would be the best person to answer that, but maybe Ms. Narula.
Yes, thank you for the question, Mr. Davidson. I think in practice, it has turned out that it is quite helpful that these ledgers are public and that we are able to track transactions. There's a huge amount of transparency that's happening, and I know that a gentleman from one of the preeminent companies that does this type of work, Chainalysis, has joined FinCEN, so presumably to help bolster their ability to do this type of tracking as well. There are some cryptocurrencies that attempt to obfuscate the entirety of the ledger. And so I think while we can rely on the transparency now, the question becomes, what will that look like in the future? These cryptocurrencies which do obfuscate the entirety of the ledger have not really caught on, I would say. They are not a majority of the usage by any means. And there are still many cryptocurrencies which do not do this. So I think it's an interesting question to see how this will evolve in the future.
Yeah, and so thanks. When you think about use cases beyond currency and beyond payment systems, the whole point is that they're transparent, like title or deed to a property, representation, access to a good or service. And so, frankly, it's way more easily audited. And I think the last thing, though, is to the greatest extent possible, I hope that we can get to the point where you get the structure in the right way. Without that third party, it really is an entirely different architecture. So I could go into that, maybe easily with the way Stellar works, is if you have to wait in a queue for a third party, that's how Swift works. And that's why Stellar is in seconds and Swift is in days, right? So the ability to, and friction costs money, people want paid and everything else. It's just a much more efficient architecture. And in some ways, there's some inherent incompatibility with third parties that basically act as a buffer. It also creates security vulnerabilities. So I'll look forward to some follow-up discussions with colleagues and with our meeting with our staff. But just thanks again. I am just so encouraged that our committee is taking time to spend on this topic. Thanks again.
Thank you, Mr. Davidson. We'll now go to Mr. Foster for his questions. Mr. Foster, I believe you are still muted.
Yeah, so on the AI task force that I'm chairing, we had a very interesting hearing having to do with techniques that go by the name of homomorphic encryption, which allow you to actually do database queries on a database you cannot see because it's cryptographically protected. And that has the potential to allow you for, one of the most sensitive design questions is whether the entity who's responsible for preventing fraudulent trading has direct access to the de-anonymized trades that are happening in whatever. Because without being able to do that, things like wash trades are nearly undetectable. Okay, there is potentially a solution out there with limitations that allows you to query this, to look at the encrypted traffic, but ask questions. Is there anyone, for example, who's trying to, if you think about the $10,000 limit for suspicious activity reports, if someone's breaking it up routinely into bazillions of small transactions, you can ask that question cryptographically without seeing all those transactions until you determine that there is one entity who's doing bazillions of small transactions to avoid triggering a threshold requirement. And so, I was just wondering, is there a lot of technical effort going into things like that allow you to sort of, split the baby between having one entity, a regulator with complete access versus a regulator that has limited access with a cryptographic barrier? So that they can't sit there and ask, how much did you spend at that store at this time? Is there anything happening in that space?
Thank you so much for the question, Representative Foster. We see a lot of great innovation and competition with respect to this. We're already seeing what we call those who analyze the chain. So chain analysis is one of them. Elliptic is another one. Elliptic does that for Stellar. And they can actually pull out this kind of information from the chain as the transactions are going. And I just have to say one other thing. I think wash trading is not always detectable, but there's definitely litigation around this already in blockchain when you do have wash trading that happens, because you can watch the transactions and see what's happening and why the transactions may have taken place. So yes, there's a lot of innovation here, and I think they'll continue to be. The beauty of it happening in the private sector is that there's going to be competition, and competition breeds even better innovation and creativity with respect to these issues. And so I'd love to see these third parties out there doing this in the private sector.
Have any of these succeeded at doing that on an encrypted ledger?
Representative Foster, for homomorphic encryption, there has been some teams that are exploring that. My understanding is that the proofs that are required are very slow still. So the performance is not there yet, although at least at a theoretical level and also at implementation level, it's possible at this point in time. It runs into some of the same issues that some of the more advanced blockchains that employ more advanced cryptography run into, which is the proofs themselves that are necessary to provide privacy are not yet performant. And so there's a number of teams in the blockchain ecosystem that are exploring that. And I'm sure other cryptographers, both in the US and in other parts of the globe, are also looking at these types of questions too. In many ways, like, blockchains are just a great petri dish, a place for experimenting with some of these more advanced forms of cryptography, including to solve some of the issues that you referenced before.
Yeah, and generally there's what they call a privacy budget associated with these, where you can't sit there and ask questions of a database in unlimited quantities, or eventually you can figure out the exact quantity of everything in the database. And so then you have an issue of enforcing that privacy budget, where I think you need something like a trusted third party. And the commercial entities that are getting into homomorphic encryption, they insert themselves as the trusted third party to enforce the privacy budget. And so you're sort of back where you were, because if you corrupt that trusted third party, then you can get past the encryption. Anyway, so over and over, when I follow down the rabbit holes here, I'm dragged back to the need for a trusted third party. And maybe it's the party I'm from, but I believe that the solution is to improve government rather than to eliminate it. Anyway, so that's anyway. I just want to thank you for helping out, communicating this to Congress. It's really important, and we have to get it right. And thanks, Steve, for setting up this briefing here. It's been very useful.
Thank you, Mr. Foster. Mr. Lynch, I'll now go to you for your closing remarks.
Sure. Thank you, Bill. Very insightful questions. And Mr. Davidson as well. Thank you for your help. I think this was enormously beneficial. Thank you, Aaron. Thank you, Denelle. Thank you, Neha, for your remarks and your contributions today. This was extremely helpful. This is the best interaction we've had on this issue. So I'll promise we'll do this some more. We have a lot of work to do. I want to thank staff. Thank you very much for setting this up technology-wise, and Kevin George from our office, and the whole team that put the witness panel together here. It was terrific. Just very, very helpful, very informative. And let's try to work ourselves into a process where we can actually think about some legislation emerging from either this task force or Bill Foster's task force to try to, set some basic pieces in place that might allow us to proceed. So very excited about this. Very grateful to our witnesses, and unfortunately, we'll be bothering you again, I'm afraid. But thank you for your kindness and your generosity with your time. And this task force meeting is now adjourned. Thank you.